The Ensemble podcast is intended for professional financial advisors. This content is created in partnership with our sponsor, Orbis Investment Advisory Proprietary Limited, ABN 15101 387 964, AFSL 237862, and is limited to publicly available information. Before acting on any general advice, you should consider whether appropriate and obtain financial advice from a qualified financial advisor. Ensemble does not hold an AFS license and does not provide any financial advice or services or endorse any general advice. If a PDS or IM exists, you should obtain a copy and review it thoroughly before making a decision.
How are you now? And welcome to the Ensemble Investment Podcast. My name is James Whelan, Head of Wealth and Distribution at InvestHouse AI, and I'm here to represent you, the humble advisor, doing their best to walk the line between client interests and asset class selection. We're trying to find the things that are not only appropriate, but that are actually working to be in the right things at the right time, the right way, for the right clients. So get set, because we are going to do our absolute best to answer some of the questions that have come up on the Ensemble platform. All information contained is general in nature. So here we go.
Orbis has been investing in undervalued global stocks for over 30 years, focusing on long-term potential rather than short-term performance. Their team of 60-plus investment professionals focuses on unearthing companies trading below their true value rather than timing market trends. With over 80 billion Australian dollars in assets under management, Orbis has consistently applied the same fundamental, long-term and contrarian approach since its inception. In today's rapidly changing investment landscape, Orbis's contrarian style and high-value exposure can make it an effective diversifier in client portfolios.
How are you now? And welcome back to the Ensemble Investor Podcast. I am and always will be James Whelan of InvestHouse.ai. That's how we're calling it. Today we're wrapping up the year that was, the opportunities that emerged in 2025, and how advisors can position portfolios for success in 2026. Joining me again for the amazing quarterly thing that we do is Vern du Preez from Orbis Investments and Daniel Kelly, who is still from Viola Private Wealth. And that's a joke. He will be forever with Viola Private Wealth. Well, Brandon, boys, how are you now?
James, good to be here. Happy New Year.
Doing good, James. How's the break?
The break was one of consumption. Look, I've got a very
doing your bit for the economy.
I was doing, consumer, I don't want to say what, but it was at home. I was full time looking after our very elderly dog, which gave us a good time to read, good time to do things, good time to do everything. But it also meant, and this is the best part, getting an itch to get back into the thick of it and actually starting to go and shake some hands and seeing people and talking to faces again. Financial services, I will say, it can't be online.
100%.
It has to be in a room, eyeballing each other over a lunch or in a meeting or over coffee or anything like that. You've got to be out there face to face with people.
Do you know, we actually talk about that all the time because we're pretty public about talking about what we're doing in portfolios and kind of something we call open source wealth management. You know how Elon open sourced the Tesla patents?
Yeah.
So we're happy to kind of talk about what we do. And the reason is that you can't replicate the magic that happens in the room between the advisor and the client.
Yep.
That can never be replicated. Yep. So,
and the trust probably doesn't translate across a Teams or Zoom screen.
Exactly.
It doesn't. And I can't, you don't get a half hour of focus from me on a team meeting or anything like that either. There will be 1,000 distractions.
Too easy to open a few other tabs.
Yeah, that's right. Or your phone bleeps off or something like that. Stuff that you can't do when you're actually face to face with someone as well. And I've said that, especially with the clients, so bring it back to advisors, is that you need to see the twitch in someone's eye when you suggest something to know that that's not okay with them and that you're not taking them down the wrong path.
Absolutely.
Because if they don't feel comfortable with it, it could be the best performing asset in the world. If they're not comfortable with it, they won't be comfortable with it.
Yeah, that behavioral feedback loop is powerful.
Exactly. And that's what you need. So happy to battle it. So what about you guys? Good breaks? Get away?
Yeah, spent Christmas break in Wagga Wagga of all places. So good they named it twice.
Yeah.
Have some friends out there. And then another little break coming up tomorrow, actually, going down to Mornington for a few days. Just my wife and the toddler I co-own for a sort of delayed little family holiday.
Oh, very good.
I had a hair transplant, as you guys know. Yeah. So I could do nothing for like 3 or 4 weeks.
Just had to sit there and just let it
do its thing. So, you just sit in an apartment for like 3 weeks. Yeah. So mine was kind of like a semi-extended break. So I couldn't go to the gym for 30 days. So I got a bit fat. So I was keen to get back.
Tell me about it. Tell me about it. It was a great Christmas. That's good. All right. So at some stage, we're going to have to crack straight back into it. I've had a bunch of stuff that's been sent around. We've had I've actually full disclosure, and now because I'm working pretty closely with AI, because I am now working for a fintech.
How's that multiple after you added the .ai, by the way? Like twice or three times higher, right?
Another zero into there, mate. That's okay. It's infinite. You're unicorn times now. So we are an AI company, and so I'm trying to. So I actually loaded in a few of our previous episodes into the Copilot, and we'll see what it spits out.
Oh, awesome.
So look, I'm going to break it up into a few different segments here. So we've got 2025, what happened and what didn't. What didn't is probably more important than anything. And then we're going to go into fears, complacency, and lessons. And then we're going to talk about opportunities beyond the obvious. That's where I think that you might come in, Vern. You're going to come in for the most of it, but that's where something that you want to talk about comes in. And then we're going to talk about risks and positioning for 2026. So that sounds pretty good with that one. Thank you for joining us, as everyone does, and thank you for the input that everyone puts into the Ensemble platform. Stick at it. What happened, what didn't, where investors may have become comfortable, and where the real opportunities and risks lie heading into 2026. I'll kick it off. What happened and what didn't? Boys, there's a free and open question for you here. What were the big expectations coming into 2025, and which ones didn't materialize? Who wants it?
Most of them didn't materialize, I would say.
Yeah. No, I reckon there was more than plenty for investors to worry about coming into the year. Politics, geopolitics, interest rates, AI disruption. And looking back at the year, like Daniel said, what's striking is that how many of those fears didn't happen at all. So most of the worries didn't change the day-to-day economics of the businesses that people are invested in or owned. We had markets fall around 15% early in the year, and then recovered and hit new record highs, and people had a pretty good year in investment markets. So the lesson might be that markets doesn't necessarily need great or good news. It just needs outcomes to be a little bit better than expectations.
Mm-hmm. Dan, and what was it? Was 2025 meant to be a recession year, or is that 2024?
I think they're all meant to be a recession.
They're all meant to be a recession. There's another one. It's going to be a recession.
No, it was.
This one's not meant to be a recession year, so that makes me think it already could be.
Well, yeah, maybe that's a contrary thing. Maybe we get the recession this year. Okay, let's go through the list of things that people thought would happen that didn't happen.
Yeah.
Resolution to Russia and Ukraine did not happen at all. That is still persisting. The tariffs didn't break the whole world economy. In fact, it's actually helping power the US economy along against all economic consensus from all professionals.
Everyone has to eat that. Like, just
everyone has to unfortunately eat that. Yeah. Whilst inflation is persistent in the US, it's nowhere near as high as what people had thought, 6, 7, 8 months on from the Liberation Day announcement.
No.
Rate cuts not as aggressive as what a lot of people had thought. We absolutely did not get a recession. In fact, we got nowhere near a recession. Actually,
Yep.
We're going to end up the year, and we'll run through. I sent to you guys before. I've done a 2025 global scoreboard, for last year across a bunch of different asset class and economic data. Yeah, the US looks like it's going to end the year once the data comes in for Q4 about 4 or 4.5% GDP growth. Right, really, really healthy growth. That's nowhere near a recession.
Yep.
Yeah, all in all, it was a good year to hold risk assets. And it's a point that I make all the time. You see, and this gets clearer as you look further in the past, right? But you see what the index has done over a year, and you just see one number. So we see 16.5% for the S&P. The MSCI World ex-US actually did 30%, which was huge for 2025. The NASDAQ did, about 20%. You see that number, and in a few years, you'll forget what happened that calendar year, and you'll think, my God, that was a really strong year.
Yeah.
They're all volatile. They're all eventful. There's always geopolitical risk. The escalation of the conflict in Iran didn't actually end up happening with the US. The US got away essentially with bombing a foreign country with the B-2 bombers, right?
That was insane.
Yeah, so that happened as well. That's almost like one of the minor news stories of 2025 to show you how eventful it was. So yeah, a ton happened, but a ton always happens.
Yep.
And it's something I've been reminding our clients of. You should never, ever expect any calendar year to be a smooth journey. They're all eventful. And if you want to get the prize of compounding money over a long period of time, you just have to stay on the roller coaster.
Yep.
Yeah. Those are all these things happening in the world. It was probably not probably didn't feel unreasonable to expect everything to go wrong at once during the year. And those fears weren't irrational by any means, but they were shared quite widely among many people and many investors. And when fears are widely shared, they also do tend to be priced into markets a fair bit.
Everything's priced. I'm coming to now. This is why the name of one of my the little joke around podcasts that I do is called The Theory of Thing. That's the basic theory that once something is known, it's priced in.
Yeah.
It's been done. It was priced in before you even knew about it.
100%.
Right? And anyone is just like, I think the market's missing this. The market's not missing it.
Yeah.
If you don't see it's priced in, it means that the market has discounted it. That's how it goes.
And maybe on that point of sort of expectations and predictions of what's going to happen in any given year, I might take the opportunity to do a small little plug.
Go for it.
Where I think at a time of the year starting in January, many fund managers typically publish their outlooks for the year and so forth, which is quite handy. We've gone a slightly different route, and I've brought you both a copy. So we released a report called 6 Courageous Questions for 2026.
No.
And the idea wasn't to go down the path of making these bold predictions and forecasts. It's almost the opposite of that, because we think it's more useful to pause and ask better questions, questions that sort of challenge your assumptions, that can maybe sharpen your thinking. Because in these sort of uncertain regimes and environments, we think that edge doesn't come from making these bold predictions, but we believe it comes from having a bit of humility and adaptability, and the willingness to change your mind when the facts change.
Yep. I do like, that's what I like about the whole Orbis setup that you guys have got to, about being able to ask those questions of things, ask those questions of yourself.
And it ranges from things like, what if Trump is right, to, is AI a bubble?
Well, do you want to kick off? Do you want to kick off and go through them while you're on it? Or do you want to bring them up as well?
I reckon we'll probably stumble into them as we go.
We get with them in. I got to say, I like the way you guys have done this.
Yeah,
thanks, Dale.
I write a quarterly CIO commentary for all our clients, and the one for last quarter is beware the forecast. Because what we were talking to our clients about is it's about this time of year that investment banks, wealth management firms, asset management firms try and pretend like they can predict the future. Because it's compelling reading. They're just almost always wrong. And I think they're increased, like the confidence interval for error is so wide now because the world is advancing so quickly, particularly with how much AI is changing every business model in the world. We should have a drinking game, by the way. Anytime someone says AI, we'll take a shot of like lemon juice or something like that.
COVID toast, because it's actually the next question. There we go.
I had a feeling. But the honest truth is the world is very difficult to predict. And I think financial markets aren't like how they were in the 1980s when things was, relatively stable. It's so difficult to foresee the world that will be even in 12 to 18 months. So I think, that approach to kind of saying like, look, we're not saying that we know where the world is going, but these are probably things you should think about.
Yeah. And that's sort of part of the angle is that we know we're not any good we don't have an edge in forecasting, but we still want to put something out there. So I reckon asking a few good questions, even though we don't have the answers, it helps you to maybe just untangle yourselves from some assumptions and from some strongly held beliefs that might not be accurate anymore.
Yeah, and it does help. I'm coming around more to the case of, yes, you do need to know what's going on in the world, especially in financial markets, because it's relevant to your life and living, but it's also more about not necessarily, should I be in or out of the market? It should be, where should I be overweight, underweight, and which particular sectors I should be into, those areas. Now, moving on, grab your glasses because we're about to get on it. So AI dominated 2025. How do you separate long-term opportunity from bubble-like behavior? Now, my expression is that 2025 was the year that we went from the tell me to the show me. And you saw quarterlies and post-earnings conference calls that CEOs make and CFOs make, and talking about, the question of, we said that AI was going to do this, and then last year was definitely what did you actually do with it? How much did it help margin? How much did it help capacity? How many people did you let go, or could you afford to let go? One of the massive tragedies that I think is ahead of us is going to be just how many people are outdone by this thing. What do you think? Did AI crack up to be what it was, and did we see the numbers? Did the rubber hit the road? I can pick another cliche.
Yeah, earnings kept up with the market. So I think that despite broad-based bubble concerns, and there was a lot of comparisons to the dot-com boom and bust, fundamentals are way closer to intrinsic value than they were during the internet bubble when it did burst. We have been kind of advising for a lot of caution at the application layer. So there's a whole layer that you can invest in behind this AI kind of thematic, all the way down to obviously the chip producers are producing the hardware that then goes into, you know, the software essentially. But you've got to be super careful at the application layer, because predicting who the winners and losers are of this massive tailwind is going to be impossible to do. And like it was with the internet boom and bust, it wasn't the people that you thought were going to be the winners. It was the good old bookstore Amazon that ended up coming out on top. And you never would have foreseen what Amazon became. And so it's incredibly difficult to price in the future of companies when they become behemoths that they weren't at the time that you were doing your analysis. So picking individual companies, super risky.
Yep.
I think the good thing about the AI thematic is, I was thinking about this the other day, you don't have to just invest in AI companies to get behind the thematic, because AI is helping every single business model in the world. Therefore, it's an economic tailwind that the entire world has never seen before.
Even it's touching on nuclear, touching on uranium, touching on water. It's you name it is.
Yeah, exactly. So like, how do you invest in AI? You actually just invest in markets. Is how you invest in AI. You don't have to pick whether Grok or OpenAI is the winner of the application race.
I'd rather not do that.
Yeah, absolutely, because one of them will be the loser. Interesting that, you know, like what you were saying about, you know, show us, don't tell us. OpenAI is switching on ads now for the first time. They're trialing it in the US.
That's why I'm using Copilot now.
At $8 a month. So I think what will be really, really interesting is how much, because obviously these platforms and these applications have enormous amounts of users gained over a shorter period of time than ever seen in history. How much of that they can monetize is going to be super interesting.
Yep. I mean, them switching on ads is a nice little signal to remind us that great tech still needs revenue. And it reminds you it's still a business. It's not a magic trick. So these things are things to keep an eye on. I think that with AI, it's a real thing, and it can be and probably is genuinely transformative, but it does still show some signs of bubble-like behavior, and those two things aren't mutually exclusive. And the warning signs are things like the capital behavior, the massive spending, lofty valuations, very little sort of tolerance for disappointment. Investors are funding this with great gusto, and the spending is getting well ahead of cash generation. So it's just things to keep an eye on, with economic realities of catching up with them a little bit. And like Daniel said, predicting who's going to be the ultimate winners in 10 years' time is extremely, extremely difficult. But it's too big a trend to just ignore. So you have to sort of just see how can you exploit this and how can you get involved in this. So we are trying to just sort of focus on stacking the odds in our favor. And that means owning various businesses that are likely to benefit from the AI trend without paying bubble level prices, because it is a powerful tool, but it's not a free pass to just overpay for anything.
Are you guys familiar with artificial general intelligence, AGI, and what that means?
Yep. I always pretend like I don't know anything, and that way I just don't get found
just
out.
To make sure. Yeah. So it's really important that everybody understands what the ultimate goal is behind all of this.
Okay.
Which is essentially digital God. That's what these businesses are trying to create. It's why Grok's logo is a black hole. Because they're trying to create the singularity.
It's the singularity, right? Okay.
You know, obviously beyond the event horizon, not even light can escape. Yeah.
So now I know I don't understand.
Okay. So have a look at the Grok logo, because it is a black hole.
Everyone's talking about this big singularity thing that's
it's essentially kind of the Skynet moment, right? The point at which, you know, artificial intelligence, the acceleration of learning of artificial intelligence runs out of control. And so to the company that can create AGI, if it's possible to create it, it should be the last technological revolution of the human race. It's that big. It's not just an improved version of Google. There's a way bigger thematic behind here. It's what Elon always talks about. And so I think we need to put the CapEx cycle in the context of what these massive tech companies are trying to achieve, because they realize that it's magnitudes of order greater than the internet could provide as far as economic value.
Okay.
They're trying to solve things like aging. They're trying to solve things like, you know, economic markets and investing, because hypothetically there's an answer to all of this, right? And so that's why they're all rushing because the one that does that, who can create AGI, can then use the AGI to essentially wipe out all competition. So
I get it.
it's an extremely exciting time to be alive, but
to pick who's going to be the winner of that race.
Impossible. It probably will be a name that none of us have heard of. That is out there, in some basement in Silicon Valley being developed right now, and there'll be a movie, if movies are still around post this. Yeah. But it's like an apocalyptic type potential moment for humanity.
The Ben Affleck movie, two things. The Ben Affleck movie Paycheck, in which they create something that can see into the future and can see all things. The stock market, every stock in the stock market crashed that day except for that one. That was I think that's probably a similar. That's
a type of future there's a potential that we live that, and whether it's a good outcome or a bad outcome for humanity is unknown. There's also something, I won't go through it today, it's a little bit complicated, but look up something called the paperclip hypothesis. It's a really good explanation of how computing science needs to be careful about the rules and regulations that you program into these models, because once it becomes autonomous and potentially self-aware, that's when things start to really get, sci-fi scared.
We've all seen those films as well.
Then to your point of sort of the, go from tell me to show me, it's probably quite reasonable to ask, with all the talk about AI, where is it actually changing the economics of individual business? Who's actually applying AI? There's been, from our perspective, quite a lot of sort of second order effects, or the less obvious beneficiaries. You have something like Caterpillar benefiting from data center builds out and those sort of things. So the picks and shovels effects is quite widespread. We mentioned nuclear, so Alphabet and Meta changing clean nuclear energy. Because people have sort of conveniently ignored the constraint that AI needs lots of power, not just code. There's also infrastructure. Companies like biotech and healthcare are using AI to speed up drug discovery, improving trial design, and those sort of things. So companies are starting to actually use the AI. They're just not just people playing around on ChatGPT.
My God, this is amazing. It's just brilliant claims.
We just do it. We don't need to
metals or mining and materials. We got to say, has been an enormous beneficiary this year of that. It listed the ASX a huge amount in 2025. I think because the world is realizing, to your point, how much energy building out the AI economy is going to take. And energy is the new currency, right? The cheaper you can get energy inputs, the more efficiently you can train models, the more efficiently you can beat your competitors.
That's effectively it. Speaking of competitor, and I've got to keep this moving because that's been that. We are comatose drunk after talking about AI so much. Who was the 13th entrant into the search market in the .com boom? And would you have invested in the 13th name to come along?
Oh man, that's a good question.
Well, you know them because they're the king of the search. It's good.
I'm guessing the answer is yes.
Google was the 13th entrant.
They're the 13th.
Yeah.
Wow.
So imagine if you've been cutting edge and just gone, I've got the guys who are the first or second to market. That's no. You got Ask Jeeves.
That's one of the advantages of 13th.
That is a great case study.
That's an amazing.
Right.
I'm gonna steal that.
That's good. You can have that. Okay. As we move on now, let's talk about rates really quickly. Expectations versus reality. What surprised you?
That didn't surprise me. I did expect inflation to be sticky. Yeah. We've been saying it for ages. I did expect locally and internationally. US probably came down quicker than maybe I would have thought. But
I think there was a few reasons behind that as well.
Yeah, and our interest rate dynamic is very different in Australia compared to the US. The mortgage market is the exact opposite. It's floating rate versus fixed rate. So, but we did absolutely expect the last components of inflation are the stickiest to undo. So to kind of get all the heavy lifting done early on with some of the more kind of discretionary spending.
So the easy stuff, yeah.
We're going
to stop going out. Yeah.
That's really, really hard to undo. So interest rates actually did exactly what I thought they were going to do.
Okay.
Yeah. I mean, even though inflation sort of eased a little bit, it seems like the sort of central banks, reserve banks kept rates a bit more restrictive for longer, which probably exposed a few entities who was relying on sort of cheap money. And maybe sort of semi-related and might a little bit off piece is that things like, the Fed's independence and those sort of things are maybe no longer just theoretical. We've seen some interesting
it
could get interesting.
Got a law case on his hands, yeah.
Funnily enough, Powell is, of all people sort of it's not a government position, but let's just say that it is because people are associated with, on a list of all high-profile US government types. he's the most trusted of anyone,
Yeah, he's such a stoic individual.
Across both sides of the aisle.
Yeah. He's had one of the hardest jobs in the world in the last.
Tell me about
it. Can you imagine, like, you know, weekly showing up to the pressure that Trump's putting on him? So
that seems pretty calm and stoic and collected, and a good head on that shoulder.
That's what you're meant to do when you're the finisher. So
he's battling. And annoyingly, to have the last couple of months of his legacy potentially being butchered by something
it might actually. I think the way that he came out and put that video out, you know, kind of stoically saying, like, look, I've served under multiple, you know, presidents. I do my job, my, you know, loyalty and you know, I am a servant of the country.
Yeah.
So it could actually help his legacy in the end.
Yeah. Well, we'll see. It's all about the way that you play it, which is good. We will come around to predictions there. Gold and silver, a structural story or a macro moment. What do you want to talk about in the precious space?
It frustrates me that the people that were lining up in Martin Place are now all up about 30%. That was amazing, right? Like,
that was good. That was good photo fodder.
Yeah.
Good Twitter photos. It's like, I can't believe these guys are around the block. And then they changed the queue to stop being one queue.
It's two.
To being two queues.
I know.
A double queue situation.
It was amazing.
It's like coming back from this is like, I've got 2 beers in my hand.
Yeah. You know, as you know, like our office in the same building, right? So every single day when I go and grab a sandwich for lunch, I saw that line. So it was like a real-time measure on, you know, the exuberance of the market. Yeah, I don't think anybody saw gold and particularly silver rallying that much. Silver doing over 100% for the year, and they're off to the races again this year. So, you know, who knew a risk-off asset acting like a risk-on asset?
Yeah, and it's weird. It's I mean, commodities behaved strangely last year. It wasn't just sort of you know, one single trade, and the sort of the cues in Martin Place with the gold, it's probably less inflation panic, the sort of the typical reasons, and more a sort of a debasement and geopolitics trade. So perhaps just sort of some trust issues starting to come through there.
Yeah,
I've got the numbers here. You want them for 2025? So gold plus 64%, silver plus 146%.
That's a good one.
Lithium plus 57%, copper plus 37%, steel was down 5%, iron ore up almost 8%, and crude oil, despite everything, with all of the potential wars, down 23% last year.
Yeah, I think there's a few. Now, I want to go through those lists as we talked about predictions coming up. We'll get to that one next time, but we've got to keep on moving along. All right, let's go to fears. Next section. Fears, complacency, and lessons. Biggest fears entering 2025? I think we've already talked about some of the biggest fears that there were going into it. Complacency. Now, Vern, I think that you wanted to talk a little bit about complacency. Where do you think that people aren't really focused on things and a little bit too lackadaisical right now?
Yeah, I think a easy mistake to make is getting too comfortable with the status quo. You know, things like the US market, for example. The US is still a big market, lots of companies, lots of great companies, but it's no longer the only game in town, even though it felt like that for a very long time. And you still had a tight group of US mega cap techs doing most of the heavy lifting and dominating returns. Those stocks trading at around 34 times earnings or thereabouts, compared to roughly 22 times for the rest of the market. So there's a lot of optimism baked in there into that default setting, into that assumption. Doesn't mean the US is now sort of an unattractive place to invest in. It just means the opportunities are likely shifted away from those most obvious headline names. And the lack of eyeballs on sort of ex-US markets means markets are full of inefficiencies that investors can exploit.
I agree with that as well, wholeheartedly. Yep. Before I go into where I think they are, because it's now time just to start talking about, you know, what can be as opposed to what has been. Where do people get a bit too comfortable for you, Dan?
Yeah, everything can't all keep going up. So I think the hot hand fallacy is probably particularly strong with investors at the moment, where it's like, basically, no matter where you're invested in 2025, had you just held on through the year, you've made more money.
Yep.
Markets can't all continue to rally across the board, almost in every single asset class. So eventually, you know, things will sell off, or there'll be some correction of some type. So just don't be too worried when that happens, because it's par for the course. You know, it's a natural part of markets, and they need readjusting. But Yeah, a lot of people made a lot of money, I think, in 2025, regardless of where they were positioned. So not all years are going to be like that.
Yeah, and it could have gone a completely different direction. I think that there was a lot of people, a lot of newspaper columns dedicated to just how bad Liberation Day was going to leave everyone and leave markets, and how it was a generational issue. I remember Bloomberg said that this is a generational situation. This is something that we'll tell our grandkids about. I don't even think we're going to remember it at the end of the year.
No one's talking about it now.
I think that the complacency right now is not eyeballing other markets, and I think that Europe is probably one of those situations that people could look at now. That the dispersion between the US market valuation and the European market valuation is now at one of those record differentials, meaning that if you go underweight one and overweight the other, the crocodile starts to come back together on that. There's a chance for something on that. I think there's a complacency on there.
Yeah. That valuation gap between the US and Europe remains quite wide, with US equities trading at or near those record highs.
Mm-hmm.
Where in Europe, Europe entered 2025 with much lower valuations, lower ownership, modest expectations. So it's not that Europe suddenly became exciting by any means. It's just it's become less bad than feared, and it's been ignored, and that seems to be that was good enough.
Yep. Slow adoption of technological improvements, i.e. in the AI space as well. And now if they capture that through 2026, even a small part of what the US has done, that'll assist.
Yeah.
And we'll see that. That's for me. That's one of my little things which I'm allowed to have on here. Any long-standing assumptions about market leadership that we saw being challenged? Who moves money? Who doesn't move money? I think we've already talked about some of these things.
I think what Liberation Day did teach us is how quickly the market can correct once the thesis changes. And I think the participation of retail money in financial markets, everyone needs to be aware that is a powerful force now, because all the barriers have been broken down to who can access markets and who can get money in. And the retail investor is a powerful cohort now. It's not just the instos that move markets around.
Yeah.
Hundreds of billions of dollars can easily find their way back in as soon as, and also retail investors have been trained to buy the dip. So there's almost this like behavioral flaw that's been put into sell-offs where they just jump back in because they've made really good money over the last 5 years doing exactly that.
Yep.
And the vast majority of the money that, that buoyed the S&P 500 that day that it did 10.5% after Trump said buy in that tweet was retail money. And the instos were late to the party. So the velocity of money moving back into markets when something changes is very, very fast.
Okay.
Yeah. And I think one of the lessons one can take from it is also that a little bit of pessimism can be quite a powerful asset, where returns came from companies earning just a little bit more than expected, paying dividends, and being priced less pessimistically over time. And exploiting that didn't require you to get the big macro calls precisely right. And at the same time, you had under the surface, you had market leadership beginning to fragment a bit, specifically in the US. So, non-US equities and currencies outperformed the US and the US dollar for the first time in a long time. And that is often how sort of the change starts, sort of quietly without any big announcement, but things are starting to change.
Do you, I'm just seeing if I've got in here what that's right. No, we didn't have that. The US dollar. I mean, it's one of your questions here, Vern. Do you want to talk about the US dollar? Now, the question that you ask is the world's safest currency. I'm assuming that's the US dollar. Okay. Look at me, just reading the cheat sheets that actually reading the text. Is the world's safest currency actually the riskiest?
Yeah.
Is the second question.
Yeah. And we put sort of safest currencies inverted brackets there. I think the lesson for investors is just banking and having blind faith that the US dollar will play that sort of shock absorber safety role for you is an assumption that you might want to think about a little bit.
Yep.
Historically, that has worked well, but there's quite a few arguments that there's a case to be made for the US dollar's dominance to unravel a little bit. Historically, when markets went down, the US dollar was a buffer, but in the most recent downturn, markets went down and the dollar went down at the same time, which is a bit unusual. So it's probably good to include in your portfolio a basket of alternative currencies, just in case the world's safest currency does falter at some point.
My question with that would be, is that an isolated case? Because the reason why that happened is America picked a fight with every single country in the world, right? So it's like...
Even their closest allies.
Yeah, it was like, so it was just shots across the bow to every single... Yeah, and then so everyone's like, okay, well, we don't know if we're friends anymore. So my question would be, is that a longer-term thematic with the US dollar, with all of the backing that is still there, and I think US exceptionalism is still in place? Or was that an isolated incident based on a particular set of circumstances because of Liberation Day?
Yeah. It was quite unique.
It was quite unique, yeah.
Unique to one individual that's actually in charge of the...
Exactly.
In charge of this.
It's like a once in a 200-year type thing, right? So I hope. So the assumption, I think I'd just be cautious about the assumption that the US dollar is just going to wither away into oblivion because there's an entire country...
Well, Vern,
that doesn't happen.
I'm going to credit your boy here, Nicholas Purser, he's got a master's from Cambridge and from Oxford. Who does he go for in the boat race?
Classy overachiever, that guy.
Oh my goodness! What has his eye? What have you done lately, though, mate? So he's got to name a few examples, if I may, that he said here for alternatives that you want to have a look at. So I did read the text. The Norwegian krona, Aussie dollar, nice, happy Australia Day. Japanese yen, all offer compelling characteristics ranging from fiscal strength and external surpluses to deep undervaluation.
And to Daniel's point, it's not shun the US dollar. It's just sort of rethink your exposure there, and maybe it's an opportune time. Just think about the potential downside a little bit, and include a basket of currencies that appear undervalued and good stores of value. Things like emerging market currencies looks to be about 20% undervalued. So maybe just add a little bit of that if you didn't have that already.
I think maybe some do African currencies entice you to it just based on what's happening in the commodities and the precious metal space? Is that something that's
not so much?
That's interesting one to think about. No,
how would you do that? How would you?
It's just a basket of
position.
ETF.
Seems punchy.
You're going to buy some. I've not bought. I was about to do my Krugerrands thing, but we're not going to talk about that now. So, where are we? All right, let's talk about other opportunities that we've got outside the Mag 7, obviously. Anything else that you're seeing on the horizon?
I mean, I have to talk up emerging markets a little bit.
And
they do feel risky, and it's because many of those risks are quite visible. The politics, the governance, currencies, volatility, etc. But because those risks are fairly visible, they are also to a large extent priced in. And EM equities are trading at a significant discount to the US. And as I mentioned, the currencies seem undervalued. So it is an opportunity. They've come out of a long period of being sort of ignored and sort of vilified. Many of the EM economies are also more fiscally conservative these days compared to the developed world. And so from that starting point, the bigger risk might be avoiding EMs altogether rather than investing in emerging markets.
Yep. What's the view on why that valuation gap has persistently been there? Because I'm always cautious on emerging markets. I think that probably emerging markets are going to be left out of lockstep with where the world is moving. So I would need a really strong argument as to why that valuation gap deserves to be closed for us to take.
For context, are we including China in the EM basket?
China's been a bit hairy for quite a while, but it's becoming less hairy. And I think if you, I think you and I had a brief chat on that. If you told somebody at the start of last year that China would deliver the performance that they did, people would probably laugh you out of the room. But they've done fairly well. So we are looking at China. It's becoming a little bit less hairy, but you still tread with caution because there are some sort of obviously some political and.
We did find 2025 bringing Chinese investment more into the fold. Some of those companies that usually have been on the nose, even though the valuations do hold quite cheap, as being in there. I do think that you guys have included them here and here. China and Taiwan make up over 50% of the MSCI EM index, of which 11% is a single stock, TSMC.
Yeah, which killed it with their just recent results that I was worried about.
Now, you've got here a CAPE ratio as well. I'm loving this thing. So I love a good chart. There is a beautiful chart that I'm looking at here that's comparing the valuations of the cyclically adjusted price to earnings ratio, the CAPE, and prospective 10-year returns. You've got the US at 38 times with at a potentially prospective 10-year returns of just around 1%. That's based on historical averages where it's sitting on the timeline here. EM sitting at 16 times, so more or less about half of that, half of the US with a 9% outlook. So that just on basic numbers, you know, if
it's just for saying that starting valuations do matter, and they are one of the best predictors of future returns. And that discrepancy there is pretty wide, but you can't just, you know, head into EMs and buy anything that moves. I think in particular in EMs, you have to be quite discerning and cherry pick the companies and the stocks that you do want to invest in, because there's lots of EM unique issues. There's lots of state-owned enterprises. There's government involvement, so you have to be careful what you invest in, and probably pay more attention to governance and shareholder alignment.
Yep, I think there's no, go on, Daniel.
I was just going to say the catalyst. I just feel like in emerging markets, the catalyst that is required for a stock to trade from a deep discount to its intrinsic value is just nowhere near as efficient as developed markets. So even if you do pick something that's undervalued, because it has to have a reason to trade up. And I think that the flow of capital and just markets being not as open as they are in emerging markets makes that catalyst trigger point much more difficult to actually happen.
Yep. I think so. It's that basic sort of Alec Cutler's in here. Sorry, I like him. It's just that I don't know. We could just buy more Mag 7. You know, where are we going to allocate? Where are we going to allocate funds to? Well, we're predicting that oil is going to go up, and so we've got these, you know, the Frontier ETF, which involves a lot of those Middle Eastern countries that you could have in there, and it used to involve Russia in there too, but obviously not anymore. But you could, it's sort of in the too hard basket.
It's and it has just had a very long period of not actually doing what the academics say it should do.
That being said, every great investment always starts off that way. So they're always the ones that hurt the most. And I still believe that an investment, at least in China, at least in some of those areas, definitely needs to be really heavily considered.
It's probably important context that we build all-weather portfolios, right? Like we build the Ray Dalio-inspired, Bridgewater-inspired all-weather portfolio that the purpose of it is so that you don't need to predict what the economy or the world is going to be in the future.
Yep.
So because we use all the tools in the toolkit, we don't have to have equity markets trending up for the portfolios to do well. So I know podcasts like this, and every podcast I do spends a lot of time talking about equities because it's what most people are invested in, but it's just a segment of our portfolio, you know? So I'm happy to always kind of provide my view on it, but there's a lot of other asset classes in the world besides listed stocks.
And that makes a lot of sense. You want to, diversification isn't just adding more things. It's adding things that will fail for different reasons, things that will behave differently in response to the same events, and those sort of things will definitely behave differently too.
Yeah, so that is the last question that I have on this entire podcast, to talk about the diversification and where we're going to be able to add assets to it.
Yeah.
So we can do it now, we can do it then.
You mentioned Alec Cutler.
Yeah.
So his sort of courageous question or outrageous question, if you want.
This is a good one.
He asked, "What if Trump is right?" And that's sort of referring to people.
I think there's a hat with that on it, isn't it?
You got a broker and a hat.
But that is an acronym.
And it's just talking to sort of people focusing more on foundational needs and self-reliance. So it's almost taking.
It's got a Maslow hierarchy over here.
It's taking Maslow's hierarchy of needs, but applying it to nations rather than to people.
Yeah.
And for a long time, sort of his theory is that capital, especially in the West, has sort of flowed to the top of the pyramid. Things like entertainment and digital platforms and other aspirational projects at the expense of the bottom of the pyramid, which made a lot of sense in a world of cheap energy and secure supply chains, etc. But when energy security, food security, industrial capacity, those things come back into focus, the priorities change pretty quickly, and capital starts moving back to that base of the pyramid needs, the things that societies can't function without. And that opens up a whole different opportunity set for investors, things like energy infrastructure and grids and transport and defense and those sort of things that's been underinvested for a very long time.
Mm-hmm. It's problematic to talk about Trump because he's so polarizing that it's difficult to just have a logical argument with anybody about it.
That's
it's so passionate.
That train left the station ages ago. You can't even say, let's just talk about it without getting into an argument about it.
But I think I've been thinking about this a lot. One of the things that made the US a superpower during World War II, that won the West the war, was America's isolationism and their non-reliance on any other economy or country in the world for their inputs and their amazing manufacturing ability. And they manufactured their way through to success. You know, the power of the US military at the start of World War II versus the end, it's amazing how far they came.
Yep.
I think Trump realizes that there is massive risk with how much the US relies on some of their adversaries for key inputs, particularly into defense. And so the way that I kind of encourage people to think about some of the decisions that, you know, that anyone in the world makes is think about it like a board game of risk, right? Even if we take Venezuela as an example.
You've got to take Greenland to be able to,
so
to be able to get five extra armies every spin. Yeah.
If you were playing risk, you would make decisions that probably you'd not be comfortable with global leaders doing.
Yes.
If you've got kind of adversaries on your doorstep, you know, if you're the Blue Army and all of a sudden your mate is kind of amassing something with the Red Army next to you, through that lens, I think we have to look at longer term kind of 100 or 200 year decisions.
Yeah.
It's not just about whether something is ethical or not, because I think they're almost separate things, right? Like what should be done, you know, ethically versus what actually gets done is quite different in the world. And so, I think that what the tariffs are meant to do is reset trade relationships so that America can actually start to kind of rely more on itself and not on anybody else, so that if some big conflict does end up happening in the future, which inevitably it will at some point.
It's driving towards the inevitability stage.
Well, it's not like it's the end of wars for humankind, right? Something will happen at some point, whether it's now or 50 years or 150 years, but that's an inevitability, I would say.
Yes.
I think he's trying to get America into a position where it's well placed.
Yeah. I mean,
so they don't have to hey, can we please still have those chips because we need to put them into the fighters that we're sending towards you. So,
yeah. So my pick actually comes off the back of that. My main pick for 2026, which is going to be tungsten. Just in you want a specific, is going to be tungsten based on the same sort of thing.
Same premise.
The US, the Department of Defense, saying that they can only bring in tungsten from allied countries. So that cutting China out of the picture completely.
Yeah.
Is going to put pressure on the upside.
There's a really funny story with the SR-72 was a very famous, one of the best looking planes of all time. The Blackbird, the SR-71 Blackbird. They actually bought the uranium for that from Russia through secret shell companies, built the plane and then spied on Russia with their own materials. You can't do that now. Like it's too hard to get away with that stuff now. So they've got to onshore it all.
Yeah. But like you said, like industrial policy and self-reliance is definitely back in focus.
Mm-hmm.
Even if that comes at the expense of efficiency, I think the self-reliance and controlling your own destiny is sort of overshadowing those efficiency.
Yep.
Globalization is dead.
Yeah, agree.
Well, it's funny. It's great to see Europe band together, and at the moment
it is actually
it's enlightening a group of people that
woken Europe up a little bit, right?
Yeah, it's all right. So Alec has got a couple of ideas here, just with the whole "what if Trump is right" situation. He does go into data centers very nicely here towards the end of it, and gas producers, gas transporters. I agree. I've got a feeling that Natty, although I'm not going to pick Natty because that's a widowmaker, but I think that oil markets are probably going to do better this year than a lot of people are factoring in. So there's some of those ones. But he talks about the small modular reactors and the reactor providers, BWXT, Rolls-Royce, are some of the names that he gives out there.
Yeah.
Any other off-grid opportunities? Small. We happen to own a website called smallcaps.com.au. So if we talk about small caps, that'd be great. But small caps, biotech, private markets, anything like that you see?
Yeah, I think small caps is attractive at the moment. We just exclusively use active management for their bunch of the funds that we use in that segment had a fantastic 2025. And it was great conditions for them.
Yep. I mean, smalls. Let's talk about smalls here. I'm cheating off your notes here, Daniel. So smalls locally, Small Ords did 20.97 last year. More room to go on this one.
It's had a good year to date so far.
The S&P small cap index, it only did 3.72. I reckon there's probably more room to go in that one coming up for this year, especially with rate cutting and with double-digit earnings growth again. I think they're coming up this year.
Yeah. I haven't had a look at it recently, but the valuation gap between large and small caps was pretty big last year.
All right.
So I think there's probably some undervaluation in that segment. Yep.
Call your mate Russell and get after it.
Absolutely.
Which is always good. All right. Anything else that you like in there?
Probably just to that point, small caps, mid caps, ex-US. I think from our perspective, the message would be just look outside the usual suspects and the headline names and the top 10. Because the opportunity, as that has narrowed, opportunity elsewhere has broadened quite a bit.
Yep.
And that's probably a good place to scratch around.
Agreed. Now, funny because what's good with doing this podcast and the other stuff that I do is that you get to talk to a pretty broad sector of the financial market. I'm going to say 2025 was the year when credit sort of came into its own, but then we did have that situation that hit where one of the biggest research providers actually pulled the plug on covering any new credit, any of that.
Yeah.
And we've actually started to the few rumors sort of coming through that maybe credit just have a really, really good look under the hood or anything that you
I was about to say, spreads are really tight. Like both investment grade and high yield spreads are really, really tight. So be cautious of exposures there. I would much prefer investment grade exposure at the moment rather than high yield because any significant dislocation, all of a sudden that credit spread is going to blow out very fast.
Yep.
And it's not going to be good for your holdings.
Yeah. No. Yeah. So IG, the preferred way to go there. And I think that with what you're getting is well and truly worth the risk.
Yeah.
Yep. Okay. That's the way I'd go as well.
North American private credit spreads are also really, really tight. So we've seen managers coming in towards the lower end of their target ranges just because of that spread tightening as well. So it's not just public markets; it's in the private markets as well. You're still getting a 200 to 300 basis point spread above public markets in the private markets for investment grade quality.
Yeah,
I would absolutely stick at the top of the capital stack. I wouldn't go both in public markets and private markets, right? I think, first loss provisions and just that protection that you get there, because going down the capital stack, you're really not being rewarded for the risk.
I think
for an extra 100 basis points, it's not worth it. Like
that's and there's an entire other podcast that's in that I think that's in that, and just have a really good sniff at some of that stuff that's going on in credit, a little bit locally. All right, moving on, and we will risks and positioning for 2026, and then we're done. Right, what tops the 2026 risk map on your risk map? Literally, you just talked about a risk map.
No, we say because we're going to be wrong.
No.
We're going to look back at these 4 quarters and go, oh man, we got that wrong.
We don't do told.
I think from our perspective, a potential big risk. We spoke about forecasts. Might not be forecasts. Might be just sticking to your assumptions too much. We mentioned that. Assumptions like things like the dollar will always protect portfolios. Assumptions like capital will stay cheap, that supply chains will remain frictionless. Those are sort of things that people just need to be mindful of. But risk and opportunity does go together. And as you mentioned, moving to things like the bottom of the pyramid type need creates opportunities based on those risks.
Yeah, I think we always talk about diversification, right? Like, of course, we're going to talk about that because we're a wealth management firm, but it's really, really risky not to have diversification in these types of markets because, like you were saying, traditional assumptions are not holding anymore in a lot of use cases.
Yep.
And so things that you thought were going to play a certain role don't necessarily play that role as well as maybe you want them to at the time that it matters. So I think you need to ensure that you are spreading your risk across risk factors and not just markets, right? So like having, adding European equity exposure to US equity exposure to emerging market equity exposure, you're actually tripling your equity factor risk, even though you've got geographic diversification.
Yep.
So if something really goes down, all of those markets are going to sell off. Like being in emerging market equities.
Oh, for sure. If you think you're not protected from an equity downturn by being in Europe.
Yeah,
it'll
they're all
downturn.
like correlations approach one. As things really get dire. So anybody that hasn't reviewed their portfolio against their strategic asset allocation, or if they don't have a strategic asset allocation, you've probably got some breathing space now to do it. Go and do that. advisors go and check that against your clients' risk profiles and just make sure that they're correctly positioned.
Yep.
Yeah, you've probably had a good year. Not a bad time to relook at things. And it seemed like across markets, our sense is that things that felt safe up to now are getting expensive, and the things that felt quite boring are starting to matter again. So, our suggestion is to try not to predict the future and make those bold predictions. It's about asking better questions, testing your assumptions, and then being willing to update your views if those inputs and facts have changed.
But it's also an amazing time to do it, because you've probably had a lot of client portfolios where equities have run really hard, and so something that was sitting at 60% of the portfolio might be sitting at 80% now. And it's pretty well known that even a 60-40 portfolio, almost 90% of the risk is dominated by equities because they're the more volatile asset class. So, good time to do it.
Yep. Okay. So it's not only looking at geographic, but also looking at asset diversification. Any other diversifications that's there? What does real diversification look like in a concentrated market? There's a reason why that question was posed.
We tried to touch on that around not just adding more tickers and more line items, because many of those things are built on very similar assumptions. You need things that behave differently and fail for different reasons. So to get genuine diversification, you need different valuation starting points, exposure to different currencies, exposure to different economic regimes, not just things that are all exposed to the same factors.
We think about, so we have two categories of the private market sleeve that we do for clients that we particularly think through this lens for. The first is the hedge fund, sleeve. And so we're not just looking at kind of leverage long equities there. We're looking at hedge funds that actually do completely different things from one each other. So you might have a macro fund, a multi-strat fund, a long-short fund, and then a merger arbitrage fund, and they're getting their returns from completely different sources.
Yep.
And then we have another sleeve we call our zero beta alt sleeve, which is where the more esoteric alternative strategies sit, like water rights, litigation lending, catastrophe bonds, things like this.
Yep.
So that when something really undoes public markets, these sleeves of the portfolio should be particularly resilient, because that's exactly their role. But I'm also not looking for those sleeves to do 15% returns. I'm happy for them to be sitting around 10%. They just need to have really low correlation, really low volatility.
You just wanted to do 10% when something doesn't
10% year after year. I totally expect that, and because their role in the portfolio is something in particular. And so I don't look at that and judge that against the equity market. That's an unfair comparison.
It's not their job.
It's not their job. It's not their job in the portfolio. I just need them to do their job, because when it matters, they need to show up.
Yeah.
All right. So, look, we've talked about currencies. We've talked about reallocation of capital. We've talked about a bunch of the questions which is there. We've talked about alternatives, which is sensational as well. So I'm just going to say one practical allocation idea each, and then I'm going to close the podcast. Who's got an idea? I'm putting mine out there and just saying that stick with the commodities, especially some of these ones. And I do like tungsten. I like a rotation into Europe as being something that you should look at for the next quarter at least. It's not a full year prediction. Anyway, like we said, you want to try and tell me where we're going to be in December of this year? I don't want to do that, man. I don't want to do that. I can give you. It's not my job, man. I don't know. That's all right, but I do think that there's going to be some rushing in this one. So I'm going to say crude. I'm going to look at the oilers. I'm going to look at tungsten, and I'm going to look at Europe. Is going to be where I think that just have a really good look at those ones.
I haven't brought this up on this podcast. I brought it up a bunch of times on others. The ESV CLP, so the Early Stage Venture Capital Limited Partnership Program that the Australian government has rolled out. Are you guys aware of kind of what? So it essentially makes, for qualifying venture capital funds in Australia, it's CGT exempt. It's capital gains tax exempt.
Yeah.
So tax-free returns. Sweet. Right? So obviously fund manager selection, all of this still applies, but that's an unfair advantage that our market has compared to those overseas. Australia has some advantages in a few segments of this. So, comparatively compared to what a US VC fund would do, an Australian VC fund, all else equal, will outperform just because of the tax treatment alone. So, do some research, be aware of those things, and then you can make some strategic allocations for clients. It's obviously very much a satellite allocation. It's not a core holding because it's definitely at the punchy end.
Oh, it is. Even just There's a lot of letters in that initialism. It's okay.
I've had to practice that a lot and not screwing it up.
So you didn't even look at your laptop either.
I mean, did you get that right? Did you get that wrong? We won't know.
I don't know. Yeah, you just say some stuff.
I think that's right. I'm pretty sure it's right.
Vern, you got one practical thing that people should be taking into the quarter?
I would say have a look at healthcare and biotechs. That's an area we found quite attractive. And sort of post the COVID era, as capital has really been sucked up by the new shiny thing called AI.
Drink.
Have a drink.
Yep.
Things like biotechs in particular has been left behind, that they've been smashed. They've got, in many cases, terrific research and development engines. They're using AI for a lot of their work, and they really getting very little credit for their pipelines and the things they have in development. So that's an area we found particularly attractive that has sort of been forgotten and left by the wayside. So maybe have a look at that.
I think the biotech, what they're using in the AI space to be able to just do the work of 1,000 people is extraordinary. And you're right, it potentially is getting overlooked.
Yeah. And if you compare that to, let's say a company like Tesla with some many sort of unproven bets and future promises that they're getting a lot of credit for, in contrast in the biotech space, they've got things in the pipeline that are much closer to reality that they're getting no benefit and credit for. So we just sort of find that discrepancy quite interesting because it's not shiny, it's not new. It's historically it's been quite spicy.
Yeah.
Then since then people have forgotten about it. So we quite enjoy the opportunity to get into biotechs at this point.
Okay.
I think the IPO market's going to be good this year.
Yeah,
it's looking.
My phone has
shaping up really nice. We've got SpaceX, Canva potentially on the board.
Canva,
OpenAI. There's going to be some big activity in the IPO market, like record-breaking IPOs. So yeah, that'll be exciting. SpaceX in particular, because that'll be the first listed public space company, right? So that's
we're living in the future.
That will make it very fun. Okay, well, I think that's going to be... I'm going to also say, with regards to things, stay away from anything that China is going into, i.e. specifically, if I want to talk about maybe European autos, is a space that I wouldn't really be too sexy about there. And I think it's great that we managed to get through this whole podcast and I'll talk about potentially one of the biggest risk factors that's coming up for the next quarter, which is that Japanese yields have absolutely blown through the roof. Do we want to have a little touch on that and just
we can. Yeah.
Okay.
Yeah. Well, I mean, the classic.
They've got about the 40 years gone above 4%. Is the
everyone's asking the question, like with such a low yield environment there, when you do that so quickly and to such a huge extent, like what breaks when that happens, right?
Things break when that happens.
Inevitably, right?
Yields rises or something breaks.
Yeah. So I don't know exactly. I'm not an expert on the Japanese market. I'm progressively becoming more educated on it. I'm paying more attention to it, particularly Japanese equities with the corporate reforms that are happening there. But that country is going through some huge changes. That new prime minister that they've got, massive public backing behind her, and she's really trying to get the country back to a growth engine that it once was many years ago. So
pay attention. It's one of those things of just like, look, if you don't get it, you should pay attention to what's going on with Japanese yields, because by the time we come and meet in 3 months' time, maybe there's a lot of stuff that has happened because of that specific
definitely
thing that's going on, and what's going on in the US as well. So there's 2 ones that you just want to be factor into what you're talking about. Talk to your advisor about it. If he doesn't understand it, give me a call. Okay, thanks.
Or us.
Yeah, one of these guys. Sorry. Yeah, thanks. All right. So thanks very much, fellas, for joining us. Vern du Preez for Orbis Investments, and these six courageous questions. I should note specifically these are for advisors and wholesale investors only. If you're retail, do not tread call. You know what I mean. Okay, this is general advice only that I'm talking about. And Daniel Kelly from Viola Private Wealth. Cheers, guys.
Thanks for having me.
Now, 2025 did remind us that assumptions need to be challenged and real diversification matters. Looking into 2026, it's about staying disciplined, selective, and valuation aware. I am James Whelan, Head of Distribution and Private Wealth for InvestHouse AI, and I thank you for joining us on this Ensemble podcast. Have a great day. Stay safe.